What you are about to witness is not a trade dispute. It is not a bilateral squabble between neighboring economies over lumber and dairy. What is unfolding between the United States and Canada in this moment is something far more consequential. A structural rupture in the post-war economic architecture that American statecraft spent 80 years constructing, and which, until very recently, most serious people assumed was beyond the reach of any single administration to dismantle. Canada, the largest trading partner the United States has ever possessed, a nation whose economic integration with America is so deep that the two countries share not merely a border, but a circulatory system, has arrived at a decision point. And the number now being discussed in Ottawa, in the financial districts of Toronto, and in the quietly alarmed offices of Wall Street portfolio managers is $900 billion. That figure is not a projection. It is not an abstraction. It represents the assessed retaliatory capacity of a sovereign nation that has concluded with apparent seriousness that accommodation is no longer a viable posture. Stay with this argument through to its conclusion, because what begins as an economic confrontation will reveal itself by the end to be something with profound constitutional, historical, and civilizational dimensions that the headlines have entirely failed to capture. Let us begin with what is visible, the surface of the matter, because even the surface is more alarming than the financial press has yet conveyed. The United States and Canada conduct approximately $900 billion in bilateral trade annually, making it the largest trading relationship in human history between two sovereign nations. This is not a number that can be disrupted incrementally. It is not a figure that accommodates surgical targeting. When the instruments of trade warfare are applied to a relationship of this magnitude, the effects are not contained. They radiate. They travel through supply chains that cross the border dozens of times before a finished product reaches a consumer. They appear in the price of automobiles manufactured in Michigan with Canadian steel and Canadian aluminum. They emerge in the cost of energy, because Canada supplies the United States with more oil than any other nation on earth, a fact that seems perpetually to surprise those who speak most loudly about American energy independence. The financial markets, which exist to price future expectations, have begun to register what policymakers have been reluctant to acknowledge openly: that a genuine trade war with Canada is not a manageable cost of political posturing. It is an event with recession-level implications. What Wall Street is experiencing, and the word panic, though it risks sensationalism, is not wholly inaccurate, is the collision between two assumptions that have governed investment calculus for decades. The first assumption is that the United States-Mexico-Canada Agreement, the successor to NAFTA, negotiated during the first Trump administration, represented a durable institutional framework. The second assumption, deeper and less often articulated, is that American economic relationships with its immediate neighbors occupy a different category from relationships with geographically distant rivals. That geography, shared infrastructure, and mutual dependency create a kind of gravitational stability that political turbulence cannot easily overcome. Both of those assumptions are now under examination in ways that market participants find genuinely disorienting. The disorientation is not irrational. It reflects a correct perception that something foundational has shifted. The Canadian response, when it fully materializes, will not look like the responses of smaller economies. This is a point worth dwelling on, because American political commentary has a persistent habit of underestimating Canada, treating it as a polite, deferential appendage of American economic life rather than as a sovereign nation with its own considerable leverage. Canada possesses something that relatively few nations in the current global environment can claim: genuine structural indispensability to the American economy. It is not indispensable in the way that a supplier of luxury goods is indispensable, inconveniently but replaceably. It is indispensable in the way that a load-bearing wall is indispensable. Remove it abruptly, and the structure does not merely shift, it fails. Canadian oil, Canadian natural gas, Canadian potash, Canadian uranium, Canadian softwood lumber. These are not products that the American economy can substitute quickly or cheaply. They are embedded in the operational reality of American industry, American agriculture, and American energy production. When Ottawa speaks now of $900 billion in retaliatory capacity, it is not engaging in the theatrical bluster that characterizes so many trade confrontations. It is describing with reasonable precision the scale of its leverage. But that is merely the surface of the matter. And the surface, as I have suggested, does not reveal the full architecture of what is happening. To understand why this moment is genuinely different from previous episodes of trade tension, different from the softwood lumber disputes of the 1980s and 1990s, different from the steel and aluminum tariffs of 2018, different even from the renegotiation of NAFTA. One must understand something about the internal political transformation that has occurred in Canada over the past several years. Canada has changed. The Canada that will respond to American economic aggression in 2025 is not the Canada that absorbed previous provocations with studied patience and quiet diplomatic maneuvering. A new political leadership in Ottawa has concluded, based on accumulated evidence, that patience is no longer rewarded, that deference to American preferences generates not reciprocity, but escalation. This conclusion, whether one regards it as correct or not, represents a transformation in Canadian strategic psychology that American policymakers appear not to have fully registered. And when a nation of 38 million people with $1 trillion trade relationship and irreplaceable resource exports undergoes a transformation in its strategic psychology, the consequences for the larger relationship are not incremental. They are categorical. Consider what $900 billion in retaliatory capacity actually means as an instrument of statecraft. Canada need not deploy the full measure of that capacity to produce significant economic pain. It needs only to credibly signal its willingness to do so, and to demonstrate, through initial targeted measures, that the signal is backed by genuine political will. The sectors most immediately vulnerable on the American side are precisely those that have been most vocal in their support for the tariff regime: energy-intensive manufacturing, agriculture, and the automotive industry. These are not coastal, cosmopolitan industries that can absorb trade disruption as an abstraction. These are industries rooted in precisely the geographic and demographic constituencies that American political calculations most need to protect. The political irony embedded in this situation is considerable, and we will examine it in depth. But even at this preliminary stage of analysis, it is worth noting that the architect of the current confrontation has, in effect, constructed a situation in which the most economically vulnerable Americans are those with the greatest exposure to Canadian retaliation. What follows in this analysis is even more consequential than what you have just encountered, because while the financial press will continue to report this story in the language of tariffs, retaliatory measures, and quarterly earnings projections, the deeper question, the question that serious students of American statecraft must eventually confront, is what this episode reveals about the structural condition of American foreign economic policy, and whether the institutional frameworks that have governed North American economic relations for 3 decades can survive not just this confrontation, but the political logic that produced it. That is the question that will determine not merely whether Wall Street recovers its composure in the coming months, but whether the American economy enters the next decade with its most important trading relationship intact or permanently reconfigured. The answer is not reassuring, and it is not simple, but it is available to those willing to follow the argument where it leads. The Canada-United States Free Trade Agreement of 1988 and its successor, the North American Free Trade Agreement of 1994, were the institutional expressions of this intellectual tradition applied to the specific geography and economic complementarity of North America. They were not, it should be noted, uncontested at the time of their passage. NAFTA, in particular, generated fierce opposition from labor constituencies in both major parties, and the political costs of its passage were considerable. But the case made for it by its proponents, by economists across the ideological spectrum, by business communities in all 3 signatory nations, and by the foreign policy establishments of 2 administrations, was grounded in precisely the Cobdenite logic that Hull had institutionalized 40 years earlier. Integrated economies, the argument ran, create not merely shared prosperity, but shared interests. Nations that depend upon one another for essential goods and services develop a stake in each other's stability. They acquire, through the ordinary operations of commerce, a powerful incentive to resolve disagreements through negotiation rather than confrontation. The relationship that developed between the United States and Canada in the 30 years following the original Free Trade Agreement was, by almost any measure, a vindication of that argument. Two nations with significant historical frictions over trade in lumber and softwood, over fishing rights, over cultural protectionism, over participation in military alliances, managed within the framework of integrated economic institutions to navigate those frictions without rupture. The relationship was not without tension, but it was, structurally, a success. What the current moment represents, then, is not a routine renegotiation of terms or a tactical deployment of leverage within a shared framework. It represents a challenge to the framework itself, and a challenge mounted with considerable historical irony by the nation that did more than any other to construct it. The United States is not merely imposing tariffs on Canadian goods. It is signaling, through the character and the rationale of those impositions, a fundamental skepticism about the value of the institutional architecture that has governed North American economic relations for 3 decades. The signals embedded in the current administration's trade policy toward Canada go beyond any specific grievance about dairy markets or defense spending or trade balances. They reflect a view of international economic relations that is, at its core, mercantilist, a view in which trade is a zero-sum competition, in which trade deficits are inherently injurious, in which the purpose of trade policy is not mutual gain, but national advantage, measured in narrow accounting terms. This view has a long history in American political thought. It was, in fact, the dominant view before Hull and the post-war liberal internationalists transformed American trade policy. But it had been, until recently, thoroughly discredited by the historical record of the 20th century. Its resurrection in the 21st century and its application to the most important bilateral trading relationship in the world constitutes what historians will likely regard as one of the more consequential intellectual reversals in the history of American foreign economic policy. The historical parallel that demands examination here, and it is one that commentators have been reluctant to invoke because of its severity, is not the trade tensions of the Reagan or George W. Bush administrations, which operated, despite their occasional protectionist measures, within the broad framework of liberal internationalism. The more instructive parallel is the period between 1929 and 1934, when the United States, in the grip of economic anxiety and political demagoguery, retreated from the relatively open trading order of the preceding decades into a defensive protectionism that proved, in the event, to be economically self-defeating and politically destabilizing. The Smoot-Hawley Tariff Act of 1930, signed by Herbert Hoover despite a petition signed by over 1,000 economists urging its veto, triggered a cascade of retaliatory measures from America's trading partners that reduced global trade by roughly 66% over the following 3 years. The economic devastation that followed was not caused by Smoot-Hawley alone. The financial collapse of 1929 was already well underway, but the tariff and its retaliation deepened and prolonged the Depression in ways that serious economic historians have documented with considerable precision. The political consequences of that economic devastation are sufficiently well known to require no elaboration here. The men who built the post-war international economic order knew that history intimately. It was, for them, not a historical abstraction, but a lived experience and a cautionary instruction. The degree to which their successors have forgotten or rejected that instruction is one of the defining features of the current political moment. It is captured in the cumulative prosperity, the political stability, and the strategic depth that 30 years of continental integration have produced for both nations. To treat that inheritance as expendable, as a bargaining chip to be discarded in the service of political calculations whose shelf life is measured in electoral cycles, is not strength. It is a failure of stewardship of the most consequential kind. And the costs of that failure, unlike the political circumstances that produced it, will not be temporary.